Wonderful. Well, welcome to the Future of Impact Investing. My name is Sydney Hulebak, and I am the director of the Georgia Social Impact Collaborative based in Atlanta. And our mission is really to focus on building an impact investing and social enterprise ecosystem, in Georgia in order to make the Southeast a destination for social impact. So I'm thrilled to be with you this morning and thankful to the planning team and Nathan Stuck in particular for making us a part of this event. And I think we have a really exciting panel for you today. But before we do that, before I introduce our panels, I want to bring on our sponsor, Bruce Allen, with Rockridge Venture Law, who's going to give us a quick tip and a quick intro to Rockridge. Hi, Bruce.
Hey, Sydney. Thanks for the intro. And good morning, everyone. Thanks so much for coming out, and sorry to be back on your screen so soon. I know it's unfortunate, but my name is Bruce Allen, and as I mentioned, I'm with Rockridge Venture Law out of Chattanooga. Rockridge is one of the sponsors for this conference, and specifically for this impact investing panel, So it's great to see this event come to fruition and to see now 85 people tuned in right now to learn more about the current state of impact investing. So a little bit about Rockridge. Rockridge is an intellectual property and technology law firm, and we work alongside social enterprises and tech companies to protect, monetize, and scale their assets. And we also perform due diligence for investor groups to help mitigate their risk. We're one of the only B Corp law firms in the Southeast, and we're proud to help make events like Build Southeast possible. Capital flow into this region is a critical part of creating an impact, so I'm thrilled to bring the topic of impact investing to the forefront and to hear the insights from this brilliant panel. Back to you, Sydney.
Thanks, Bruce, and thanks for the support from Rockridge. I will now bring on the rest of our panelists, starting with Daniel Nicholson, who is the CEO and president of Nadamu, the great ice cream you heard about earlier, and he's coming to us from Texas. We also have Stephanie Crowe, the founder and CEO of AegleWealth, coming to us from Tennessee. We have Dominic Miarton, the president and CEO of Optus Bank from South Carolina. And then finally, we have Zain Mahmood, the founder and CEO of Florida Social Capital, coming to us from Florida. So we have good Southeastern representation this morning. So once our panelists join us, we will get started. Hey, Stephanie.
Hey, good morning.
Good morning. We'll start with our first question for you, which is really just an introduction. So I said your name and title, but if you'll tell us a little bit more about yourself and your current work, and perhaps how you got there. What was your path to working in the impact investing space?
Absolutely. So I'm a career financier. I got started in a trust department with a predecessor to Bank of America. Have been in investments for about 25 years. I didn't realize I was an entrepreneur until just ahead of the financial crisis. I joined a startup bank, a de novo bank, and built that company from the ground floor. I had just completed my MBA, so it was like really exciting to like build an organization from the ground. And we were super successful. We sold that company. But in the middle of this, I was seeing all kinds of opportunities around women, empowering demographics that I thought were not accessing the banking system, and joined a group of women to launch the Jump Fund. And the Jump Fund is based in Chattanooga, Tennessee. We had a gender lens investment focus. There really wasn't terminology around impact investing. We just got together and said, we want to invest in women. And we were actually told initially that there wouldn't be anything to invest in. But anyways, we were doing impact investing before there was a thing. We had people tell us, this is charitable. You should be a nonprofit. You're not going to make money. I would only give you money if this were a write-off. Like it was beyond belief. But this panel will speak to why they decided an impact focus was important. I was doing an impact focus before it was even a thing, because I just saw the need. And just in the last year have launched AegleWealth, which is a wealth advisory firm, very much a boutique. For 20 years, I was focusing on multi-million-dollar men because they had the capital. And now that I'm in my 50s and I've got another 20-year run, I really want to empower entrepreneurs who are thinking about not just making money, but doing good. And these are people that may not today feel like they have a place in the traditional industry. So I'm kind of focusing on people who aren't sure, that the structure that exists today is exactly aligned with them. And to see what's happening in the B Corp movement in the Southeast is really exciting, because I don't think making money and doing good has to be two separate things. I love to see forward thinking, energetic, bright minds bring the two concepts together. And I think it's really going to transform the South, given enough time.
Amazing. Well, thanks for sharing about both of the hats you wear. And as we dig into that further, would love to know, how do you define impact in both of those roles, both with the Jump Fund and with AegleWealth?
And I can speak to this on both sides, because on my wealth advisory side, ESG, SRI, impact investing is something that a lot of advisors are struggling to define. More and more people are running to the space and they want to put the label on their investment. But to figure out what that means is a big industry opportunity and challenge. The Jump Fund, when we formed, 8 years ago, we basically were just looking at the rates that startups were being funded. And we saw a huge deficit in how women were accessing capital. So it was like we weren't thinking of ourselves as impact investors. We were just thinking, hey, there's a challenge for women accessing capital, so how can we fix it? And within a couple of years of that coming out, there were certain standards around gender lens investing. In fact, our little fund applied and we've been certified as a GEN investor. There's like a certification now for gender lens. So you have to meet certain parameters. And I would say, as a woman investing in women, we've been tested. Like, we've had people coming to us for capital, like, does this qualify as a women-led? Does this qualify as a women-led? So even when you're an impact investor, I would say that you've got to figure out what your thesis is, what the impact is that you're trying to achieve, and then stay really true to that, because sometimes opportunities, I've seen teams and companies try to morph to fit the box that they think you're solving for, and it may or may not exactly align. Impact is all over the board. It might be environmental. For us, it was socioeconomic and gender-based. We also had a Southeastern focus. We didn't want to be another investor in another Silicon Valley company. We wanted to focus on the South. So I would say that, as you ask about impact, and our panelists will speak to this, it is such a broad terrain, and you can really craft your own definition. And there's a lot of room to play. Hey, Michael.
It's great to see you.
Good to see you.
Michael, where are you joining us from today?
So I'm in Nashville, Tennessee.
Oh, wonderful.
Yeah, great to see you.
You as well. Stephanie, really quickly, as a follow-up to what you just mentioned, talking about impact and really how in the capital raising processes for both these entrepreneurs you're working with, as well as for the funds you're helping to establish yourself, what are some of the challenges or opportunities you've seen in raising capital in this space?
So I love this question. 8 years ago, I was wearing my financial hat, dealing with a lot of men, both financiers, and then most of my clients were men. And then all of my civic work seemed to focus on, like, women as leaders, running nonprofits, raising funds for charitable causes. And I was sort of like, why are these two worlds so disparate? So the Jump Fund, to speak to one of the very core challenges, we went to women who were doing very charitable things that were aligned with our mission and values. They were writing charitable checks. And we went to them and said, how would you feel about making an investment? And there wasn't even a lens for that. They didn't know that they could invest money. All they were used to doing was giving money away, doing impact by giving money away. And they got so excited about actually having an opportunity to build their own wealth and have the kind of impact they were seeking. So we invested in a ton of education. We created a very low barrier. Our very first fund, the minimum amount to invest was $30,000, which is really low when you speak about angel investors. In the angel investment space, there is an accredited investor threshold. So these are considered high risk, long-term, very illiquid investments. So the women that had access to these investments had to have $1 million in net worth, excluding their home. So it was interesting because we were we were addressing women who were very sophisticated if you looked at their financials, but they were not at all engaged in making early stage company investing. So we had to coach, educate, empower, and some basically just wrote us a check and said, keep me posted. And others really wanted to know. So we didn't want to force feed anybody more information than they were interested in. But many have since gotten involved in advising. We have now, several investors who are serving on boards. It's just really been beautiful to see how many women are getting involved in something that feels very grassroots. But these little companies will grow up. Not all of them will win and succeed. But as these little companies grow, their impact will also grow. And we're changing ratios by even seeding small successes. Another challenge, what was really fun was not being offended. In the very first fund, men were a little bit dismissive. The men who had experience in this space, they're like, I'm investing in all kinds of companies and I don't see women, so these opportunities must not exist. Like, they really said, like, these opportunities don't exist. You guys are going to waste your time and you're not going to find anything to invest in. So we had to just make sure that we were having, very, we just had a tough skin. We didn't get offended. We're like, we understand your position. We understand you're not seeing these opportunities. We think we'll find them. And a good number of these guys for our second fund said, wow, we didn't know. We didn't see it. Can we invest with you now? And so that second fund, we actually deliberated. We're like, we're a women's thing. Should we just stick with women's capital? And then we said, hell no. If our mission is to maximize capital going to diverse teams, why wouldn't we take the capital of men? So that was just a really fun, it shows you how even when you do have barriers and disbelievers, if you achieve success, you can sometimes get the buy-in that you didn't have originally. Don't be offended. Just understand if they don't see it, they don't see it. And eventually they might, and then bring them on board.
No, that's amazing, Stephanie. And thank you for sharing that journey. Michael, I want to give you a quick chance to introduce yourself and share a little bit about what you do and what path brought you here.
Sure. Yeah. So thanks for allowing me to be a surprise panelist here. So I have my own advisory firm. I have a history in sort of traditional finance, traditional banking, investment banking, corporate lending, and a few years ago decided to transition that skill set to help other people. And so I've worked in asset management for impact investing funds. I've worked in social enterprise consulting. I've worked in nonprofit management. And most recently, I started my own company working with social entrepreneurs and underrepresented entrepreneurs to navigate the impact capital landscape. And so, Stephanie, I greatly appreciate the work that you're doing in operating a fund and also on the education piece, because what we see, I think specifically in the Southeast, is a complete lack of capital for early stage investment opportunities. And so I'm sort of on the other side of the equation from where you are, right? Like, I'm working with the early stage entrepreneurs to figure out, okay, who do we need to talk to? Who's actually funding these opportunities? And how do I speak to them? And so what we've come across is sort of it's a very unfortunate sort of capital situation that we have here, because if you look at the impact investing ecosystem overall on a global scale, there's $715 billion of impact assets under management. And so when you look a little bit deeper at those numbers, only 13% of that is going towards private equity and venture capital investments. And a fraction of that, about 10%, is going towards venture specifically. So that leaves us with $9 billion globally for impact venture capital. But what we're seeing in venture capital is that because it's so popular, and especially in the impact space, big dollar amounts are flowing to those funds, which means that they need to be writing bigger checks, and they're looking at later stage opportunities. So when it comes to the innovators, the true early stage social entrepreneurs, 7% of venture capital is going towards the early stage, truly innovative capital opportunities. And so we're getting down into the hundreds of millions of dollars worth of funding opportunity. And there is this bias in the space that Stephanie's talking about, where the capital's really still flowing to white guys in San Francisco and New York. So the opportunity to get funding, if you are a woman, if you're African American, if you're a social impact organization in the Southeast, it's tough. It is really hard to find that money simply because of the math that's going into the system. And so there's a big need for the education, and there's a big need for these events to be bringing education to the space and pushing people towards it.
Michael, I want you to talk about this because I think this is what I noticed was seasoned investors who tended to be white, wealthy guys that I had worked with. Like I've been in asset management for 20 years. So these are my friends. Like they weren't evil. But as I was engaging with female-led companies, I could see that this posse saw risk very differently. You know, I was bringing teams that they weren't used to engaging with, and all they saw was risk. Like, so it's really, maybe you can speak to this, that early stage company is risky, whether you're white, whether you're male, whether you're black, but what's so funny is that when people who are seasoned in the space are used to doing it a certain way, they feel a different kind of risk when you bring a different kind of entrepreneur to them. Can you speak to that?
Yeah, absolutely. So when you have investors, they have underwriting criteria. So they have specific things that they look for, and they've had the same specific things for decades and decades and decades, and they're not looking to the future. So really in the early stage, especially in the impact space, we're talking about really favorable leading economic indicators. So for the millennial demographic, right, we are becoming the largest purchasers of products and services in the country. We are about to inherit $40 trillion worth of wealth from the boomer generation. So our opinion really matters in terms of the future purchasing and investing behavior that we're going to see nationally, but that's being left out of the underwriting criteria and framework right now, because if you looked at the data and you saw that 95% of millennials are interested in impact investing, a majority of them are willing to pay more for products and services provided by companies that have diversity, equity, inclusion, and have social impact built into their models. And a majority of us want to work for companies that have impact built into their models. It would be a no-brainer. If I were taking that into consideration, impact companies with diverse founders would get every check that I wrote, but my underwriting hasn't evolved to the future. And so that's what I think is the problem with the people who aren't evil, right? They're looking for good opportunities. They need the education. They need to be brought along to the future and where the trends are really pointing.
Thanks for that perspective, Michael. And I want to stop for a second and introduce our final panelist that just arrived, Vicki Benjamin. So Vicki, if you'll introduce yourself and talk a little bit about your work and how you got there.
Oh, okay, great. As Sydney said, my name is Vicki Benjamin. I'm the president of Karner Blue Capital, co-founder with Andrew Niebler, former general counsel of Calvert Investments. Prior to founding Karner Blue Capital, I was the president and CFO of Calvert Investments. And for the last decade of my life, I've been devoted to using the capital markets to move forward the lives of people, animals, and the planet. And thank you for letting me join the panel.
Absolutely. And we're actually getting some great questions in the chat. So I do want to pull these into the conversation. Don asked, it's especially difficult for CDFIs to tap into large amounts of capital. CDFIs typically deploy capital into traditionally low wealth people and communities, thus yielding tremendous impact and catalytic changes in the local community. How can impact investors and fund managers increase partnerships with CDFIs? Anyone that wants to take that, you're welcome to start.
I don't know if you have any experience. I've come up on the traditional bank side, and I can just share a million reasons why bankers hate risk. They want high liquidity. They want lots of financials. Like, I've just been in the room watching them pick apart an early stage opportunity. Bankers are not risk takers. Let's just put it that way. So like I haven't had a heart for CDFIs. I don't think there are enough of them. I agree that if we could lead with them, communities would be stronger. Something that we can speak to, I think, as a panel is, I've seen this, I've had bright women with solid business ideas come to me as a gem fund general partner, and they're looking for capital because we know they know that we're looking through a gender lens. But not all of these companies are VC styled investments. Not all of them are going to be hockey stick growth. And that doesn't mean they're wrong. It doesn't mean this founder's not going to be successful and build real value. So for me, I've enjoyed being an angel. It's been fun to back some companies that I think are be real winners and to see female leadership really, fly. But I've also seen a good number of like solid Main Street companies that are led by diverse founders, and they really have no business chasing angel capital. Like the expectations that the angel and VC world would have on them would completely contort their company. And so to the CDFI question, I think the best thing Michael can do and anybody in the space can do is say, you are dynamite. We're in support of diverse founders. But if your business model doesn't align with VC, don't try to jam it in there. Let's find a CDFI that's going to dance with you. Or I have a friend, Jonathan Brogdon, who started a funding pool that is more debt-based. They're not taking equity. It's debt-based. So like it's going to do well for their investors. And it actually is a better fit for companies that aren't going to hockey stick. Michael, you may want to speak to this a little bit more, like how you align your capital with your business model means everything.
Yeah. So to your point, CDFIs, angels, VCs, private equity, they each have a different risk and return profile that makes them a good funding opportunity for businesses that look very different. So CDFIs were kind of the original impact investment vehicle in that they were designed decades ago specifically to drive capital into underserved census tracts. And so when I think about that, I guess there are two parts of the question: impact investors and fund managers. If we're going to talk about impact investors as a family office or a high net worth individual, someone who's managing their pool of capital towards impact, and they have different investment options, a CDFI fits a different part of my portfolio. So a CDFI, as Stephanie mentioned, they're going to be lending. It's going to be low risk. It's going to represent cash flow. So there's an interest rate that CDFIs are going after in the loans that they make that presents cash flow, which is important for an impact investor's portfolio. But in other sections of their portfolio, they're also going to have venture capital, private equity to take higher risk and present higher financial returns. So if the fixed income portion of your portfolio as an impact investor is just idly allocated to different financial institutions and low risk investments, think about CDFIs instead, because then your money's going to go to a different place. When I think about fund managers, that to me represents the private equity groups, the venture capital groups, angel networks, and the ones specifically writing checks into companies seeking higher risk for their returns. The partnerships between fund managers and CDFIs have to be a little bit more creative. There's one example I can speak to from a company that I'm working with right now, who has created an e-learning platform to help transitioning military veterans learn about how to become builder developers in the residential real estate space. And so we're out looking for venture capital right now to fund an e-learning workforce development opportunity that actually drives capital towards distressed zones and creates a pathway to wealth for veterans. But we're looking for partnerships with CDFIs as well to provide debt financing for the homes and the projects that the veterans are working on. So, we can have a VC fund and a CDFI coming to the table to drive impact on both sides of our model. But there are some pretty significant differences that are important, but they can work together in some cases.
Hey, Sydney.
Yeah.
I just want to insert really quick, and Vicki might be able to speak to this because she's been part of closing things, the ending, and I've been part of an exit too. But I think an important thing to consider with impact styled founders is VCs expect an exit. And people that start companies because of passion don't necessarily want to build them to sell them. And that's you have to be really clear about who's investing with you. A lender doesn't care if you sell, right, Michael? Like if somebody's dead on your balance sheet, they're not going to force an exit on you. necessarily. But I think that expectation, especially for an impact crowd, if you're really, really passionate, just be aware of what the investor expectations are. And selling a company, that new owner may or may not share the passion for your, like they may or may not be aligned, and you kind of lose control at that point.
So Stephanie and Michael, quick question. Do you think, and maybe this is more directed towards Stephanie, when VC comes into an impact entity, are they looking for more of a concessionary return because of the impact, or are their expectations the same? Because for me, I started after exiting Calvert, which was a very large 40 act shop, 14 billion in assets. We started Karner Blue Capital, which is an SEC registered investment advisor. And we are not attracting venture cap because venture cap wants an exit strategy, and an exit strategy that's able to exit in a short runway, 3 to 4 years. So they expect that you're going to ramp up and deliver annualized returns of probably 15%, right? And that is not what the attraction. If I wanted an exit event, which I don't. This is my lifelong dream, is to move forward, use the capital markets to improve the world. And if I wanted an exit, that would fit. But the attraction of a registered investment advisor or an impact investor, even if you were doing just traditional impact or a CDFI, is the fact that its returns are annualized, right? So you don't need an exit return. You don't need an exit event to monetize your returns. You actually get them in the form of an annuity once you reach scale. So my thought is you reach scale. Now don't launch a mutual fund right before a pandemic. That's the only advice I really can share with panelists and the audience. But you can usually reach scale after you've had a 3-year track record, right? And then you start to annuitize the earnings and to pay your shareholders. But I don't think a lot of VC folks are looking for an annualized annuitized return. They're looking for a big liquidation event.
So Vicki, I love you asking this question. I'm 51, so I've made some individual commitments, but I've got a long pathway. I don't need cash back in 5 years. I make these commitments because I believe in the effort, and I do expect to make money. But there's no where I've got to have my money back. With the Jump Fund, we've got 2 funds and 90 investors, and these women will want to get out of the fund. Like, they're not investing in the fund forever. So like as GPs of this fund, we don't want to be forever on the hook. So we had a time horizon, 10 years, where we wanted to have everything shut down. And that means we need exits. We need, or if something, or just call it a loss, right? So by virtue of being a fund, we have pressure to deliver to our LPs and wrap up the show. But if I were a family office, say I built a company and had to exit, I was Jeff Bezos. And I set up my family office, and I set up a foundation that also does impact investing. I could play this like Warren Buffett would play it, which is structure it in such a way that this is a legacy of investment that lives outside of me. Like, I'm gone, but I still have my team, and these are investments that will be there for my kids and my grandkids and their kids. So like, there are investment entities that have these horizons that will give the right company way more flexibility. I think the bigger challenge, Vicki, is, and I think I touched on this, and Michael may have seen this already, but as companies grow, and the Jump Fund even has had some real winners. Well, when we first got started, we were writing $75,000 checks, which is very small for this world. Not many people would start at that stage. But for our winners, as they need bigger funding entities, people are getting, seats on the board. And then if they do sell, or if somebody, like in one case, we had a big investor that kind of forced a conversion of a company and forced a conversion of the management team, which meant it lost its female founder. And so all of a sudden now the gem fund has a company that's all male run. Like, we didn't really expect 4 years into it to have one of our portfolio companies an all male team. So what's a challenge, I think, related to impact and any kind of lens that you use as an investor, as a company's life evolves and they need other players to fulfill whatever they're doing, to sometimes just to stay alive, those other investors may or may not be aligned, and it can really distort and pull you in ways that you didn't anticipate. And then again, if you do exit, is it to a company that's going to guard and steward the mission? Or is it a company that just wants it for some other purpose and the heart of the company is just going to be ripped out and tossed to the curb? I'm sorry to sound so, that sounded very jaded.
No, I appreciate that perspective. And it actually segues nicely into another question I have for you all, which is really focusing on that impact measurement and metrics that play a role in your work as a funder. And in particular, how do you gauge the impact of potential investees or current investees who do have those changes in their leadership and their business models over time? And how do you ensure the impact is growing? If that's an important metric to you, is that something that should be iterative in these social impact-minded companies? Or is it something that if they start out with that kind of baked into the ethos of their business, that's enough for you as a funder? So maybe let's start with Vicki here.
Well, I represent, thank you. I represent the large capital markets. So impact is generally done in the in accordance with socially responsible investing. You're impacting the cost of capital by allocating capital into good companies and thereby allocating it out of bad companies. But the most critical part of impact in a large cap space is an advocacy initiative. And that means engaging with companies and encouraging them to improve their practices. So that is the underlying hypothesis of socially responsible investing. That said, when you have investors, and I consider pretty much everyone's an investor, whether it's through your 401k or a Robinhood account with $10 in it, or you've saved a little money, or your grandmother left you money. Pretty much a lot of people are investors. They may not know it. But if you are an investor and you want to make a difference and you want to help a socially responsible investment firm like mine and others out there, you'll invest in those strategies that align with your values. So if you don't believe in fossil fuels and you have an avoidance strategy in your head, you really don't want to invest in those, then you have to proactively look for funds that align with your values. So investors and in the large cap space, you can create impact, although and as you see, there are billions and soon trillions of dollars that'll be moving into the ESG/SRI space that definitely will reallocate capital and move forward progress on these initiatives. But we actually need underlying retail investors, like the folks on this panel and the folks in the audience, to also influence changes in capital allocations, not just institutional investors, by carefully selecting those strategies that align with their values. And not just saying, oh, this is all I've got. I've got this large cap fund that has Exxon in it, Mobil. I have this fund that has Tyson's in it, or McDonald's. I don't want exposure to animal cruelty. You really have to think about it. And maybe just one investor doesn't make a difference, but I can tell you hundreds of thousands do. So impact for me in the large cap space has got a longer runway than an individual initiative that'll help a one-off lender or borrower, et cetera. But I think it's very important because the lever of large companies and large corporations and the impact they have on the world is incredibly significant.
Michael, would you like to go next?
Yeah, absolutely. So I heard three parts to the question. This is, as a social venture, how do you measure, protect, and scale your impact? Measurement is the billion-dollar question. I mean, there are so many groups trying to solve for that right now. How do we consistently measure impact across organizations? Because as humans, as finance people, we want to compare. We want to see what's the best option, and we want to invest in that particular thing. And so in the traditional finance world, there are generally accepted accounting principles that allow us to track specifically how money flows through organizations, and we can make investment decisions based on the outcomes of accounting. However, no such standardized measurement system exists for every area of impact. I mean, when we're talking about global poverty, workforce development, education, health and wellness, these are things that can't exactly be compared to one another. And so from the measurement piece, it's really about, as a leader in an organization, being creative about the things that you want to track and being consistent about the things that you want to track, and really focus on the things where you want to have the biggest impact as a business leader, and making sure that those are included in your key performance indicators or KPIs, so that when your management team is meeting, you can see, okay, here's revenue, here's cost, here's profit, we're doing well financially, but also let's look at our impact KPIs and make sure that we're up to snuff here, because that really matters. And then, so that's measurement. Protection, there are different ways to make sure that the impact you want to create is intentionally incorporated into your organization. You can be a public benefit corp, you could be 3LC. My friends at Rockridge Venture Law can probably help you out a little bit more than I can with what those designations mean, but you can create an entity structure that legally allows you to take impact and community into your managerial decision making. And if you're a C Corp or one of the other traditional entity structures, you have to consider profit. And that's the way you make decisions. And that's how you reward your shareholders, instead of looking at stakeholders. But you can pick entity structures as a social enterprise. You can design your processes and procedures and decision-making around considerations of the community and the impact that you want to have. Then the third part of the question, how do you scale that impact? You have to make sure that it's built into your revenue model, or you have to make sure that it's built into your operating model. So every product I sell, every tuition dollar that I get in is helping someone at the end of the day, or I'm being intentional about my hiring practices, or I'm being intentional about my supply chain. And I've made sure that that's codified in my governance or my processes or my procedures, so that the bigger my company gets, the more money is flowing towards these things that I care about, and the greater impact that my organization is able to have.
I'd love to add on to this, and I'm going to use a very specific example. One of the few fintech companies that the Gem Funds found is based in Florida, and I fell in love with this founder when she sent her pitch deck through our process, our application process. And what she was envisioning with her company was exactly what I thought a bank should be doing. Like the people that had just $100 that I would have been smacked for, chasing down, opening up $100 account. Because that's how banking is driven on big numbers and big transactions. That's how they hit their profitability targets. This founder came from the crowdsourcing arena, was structuring a company that aligned with Reg A, new legislation. And the company is Worthy Financial. When I saw her, she was trying to raise $750,000 and using an application. It's a fintech, like using an app. She's selling $10 bonds yielding 5%, and they take the funds and do inventory secured lending on the other side. So she's got no bricks and mortar. She has maybe 25,000 users on her platform. With as little as $50, somebody can, buy Worthy bonds and earn 5%. She's got a roundup feature. And what's beautiful is she now has clients in 50 states. So it's just, you can just see the numbers of people with just $100. I just want to put $100 somewhere where I'm going to earn something. There are so many places where the current industry is not serving people well, and visionary founders can strike a chord. And what's beautiful to see about Worthy is people are on YouTube doing like little tutorials about their Worthy account. There's marketing happening organically that a bank would just die for. To see just a guy that doesn't look like he has any financial savvy saying, hey, look what my, Worthy bonds are earning me, and kind of showing his little fan base how they can save and invest and accrue a savings is beautiful. The other last thing is I want to say about Worthy, and I'm on the board here. So I've been watching this management team grow and develop, and to see how, hey Zain, to see how from a management perspective, they are talking about their impact every day with every decision. So as they achieve success, they don't want to like shift and start playing like any other bank or financial institution. It's almost like at every key point where a decision's being made, they're like, who is our crowd? How do we serve them well? Where are we committed? And a good example of this is Worthy has applied to their SEC supervised, so that it's a public reporting privately held company, which is really unusual in the angel space to have a company that has like SEC styled reporting. They are working on approval by the SEC to come out with a qualified offering, which means non-accredited and accredited investors. So their users on their platform could buy a piece of Worthy. And they're waiting for approval on that. They're hoping that this offering is available next year. What's so phenomenal about this is an angel investor group, a VC group, wants to have a clean cap table. They don't want $1,000 holders of equity in the company. It's Worthy is making a decision to allow the people that they serve to have a piece of their company, so that those people will not just benefit from savings and the yield of Worthy bonds, but could also benefit from the appreciation of being a Worthy equity holder. And they are kind of going against the grain and expectations of what other angels and VCs would want them to do. So that's like a real like clear point of when you say your impact, mean it, stick to it, even if it means going against the grain of other, like what other VCs and angels might expect you to deliver.
Thanks, Stephanie. I want to welcome Zain and give you a chance to introduce yourself briefly and talk a little bit about your work with Florida Social Capital.
Sure. Zain Mahmood. I was born and raised in Bangladesh. I came here at the age of 18 with very little and got my engineering degree and started working in large companies and worked in the private equity side. Also really got introduced to impact investment when I worked for a company by the name of Parkson, which was owned by a family out of Sweden. And they did all their investment was based on doing good and making money at the same time. So that stayed with me. Later on, when I had a chance, I started building an impact investment fund in the state of Florida, focused around the state of Florida. And really, there's a really nice ecosystem of entrepreneurship going on in Florida. And our focus is to really help these companies expand their impact. We have designed an impact measurement score for the state of Florida using United Nations SDG gold standards, and that's what we help these companies measure them and then help them expand their impact while we are investing in them.
Thanks, Zain. And I'll pop this question back to you, but given that we're at a B Corp conference, what role does B Corp status play in your decision making as funders? So Zain, if you want to start there, and then we'll go to others.
Sure. The challenge has been so far with, we have looked at 200 companies in the last 6 months that are at different stages of growth. This is early stage investment. Most of these companies, we focus in on health tech, edutech, food, farm to table or that kind of companies with some technology angle, and housing, and green tech. Most of these companies don't view themselves as an impact creation company. They are just doing what they do. They're trying to serve their customers, build new products, build new offerings, things like that. Where we have found the biggest challenge when we talk to them about impact is, and we have asked several companies. We haven't actually we've seen 3 companies that knew about B Corps. Florida is one of those places where news travels very late. Much later from a technology standpoint. So there is a small movement of B Corps here, but they are somewhat in the lifestyle businesses, much more so in the ecosystem of entrepreneurship. So knowledge is a big issue. People don't know what B Corps are. That's the first thing. Second, these smaller companies, I feel like they're making a decision. Do I hire an engineer or a part-time engineer, or go and file for B Corp? Because there hasn't been a vehicle that really rewards being a B Corp or recognizes being a B Corp. It's just a big impediment when you're a startup entrepreneur to say, where does my money go? So they actually really welcome, because what we were doing as a part of our due diligence is we would give them an impact investment score for free, because our tools are relatively simple. They're not as segmented as a B Corp tool. So, and that was enough for them to get started. Our advice to them is, look, down the road, when you start getting to a point where being a B Corp really makes a difference for you to go and raise bigger money, go for that. But right now, just use this as a base tool, and this will get you, 70% there may not be 100% there. So that's kind of been our approach.
So I'll just interject a little bit. When Andrew and I founded Karner Blue Capital, we knew at the very beginning that to be a true impact investor, the B Corp status was very much credentializing. And I guess, Zain, I would challenge your hypothesis that it's better to do it down the road. I find that starting out with this in your corporate charter and starting out in your operating procedures, being a true impact investor, a sustainable investor, makes you think about it in your daily operations. How do I maintain that certification? I have to report on it every 3 years. And I know that as a company gets larger, and you, especially when you have multinational subsidiaries, implementing that kind of certification and those kind of criteria across different nations will be a challenge. I know Dannon had a very large challenge. So I think for startups, it's easier to just say, let's bite the bullet, let's document. And it wasn't a lot of effort for us. We're tiny, 12 people. I think you can really, it's embedded in your culture. And just as we look at right now, part of the review of looking at the impact of large companies is reviewing their sustainability reports. And only 80% of companies, large corporate companies, have sustainability reports. And it's because it is very hard to pull that information together, especially now with the backdrop of COVID. Priorities have changed. So
Hey, Vicki.
I'm not disagreeing with you, Vicki. I think you're absolutely right. It's just when you're a small entrepreneur and trying to make decisions, it becomes a cost issue. If B Corp formation and maintenance was a relatively low cost thing, I think you have to demonstrate to these investors that it has a longer term value, especially when you go to raise money as an impact investment, right? I am not disagreeing with you at all. It's a choice. And what we have found for 200 companies we've looked at in Florida, only 3 of them knew about B Corps and none of them had filed. So again, I'm not disagreeing with you. I'm just telling you the state of Florida and where things are. Again, as I said early on, Florida news travels really, really slow here.
Hey, Zain, I love
sorry.
this discussion. And Vicki, I would say you as a mutual fund doing impact investing, having that B Corp status was like a non-negotiable, right? Like, and you are working with institutional investors. You're a mutual fund. But to Zain's point, what I've seen is the everyday startup isn't yet on that stage. They're not they're not even talking to people of the caliber of the people that are going to invest in your fund. And so and typically they get out of the gate with kind of mom and pop dollars. So by the time they stumble into Zain's shop, they don't even know what an institutional investor really needs. So Zain's kind of on that very first point of coaching them into what the big boys are going to expect. So Zain, I hear you, and I'm doing this with Worthy Financial right now. I'm like, guys, we're really growing up fast, and we are an impact venture. We're just not certified. We're speaking it, we're doing it, we're living it. Having the certification is going to matter as you get to bigger and bigger stages.
I agree with both of your points, but there are only 100 registered investment firms in the country that are B certified. It's the mutual fund is not certified. Our company is, and my only point, and I'll leave it at this, is if you embed it in the culture, and I don't think there's anyone that works for me that doesn't know to, our policies on inclusivity, recycling, and regeneration, and those, and it's not really that hard. So I can understand there are costs in reporting, much like there are with UNPRI, United Nations Principles of Responsible Investing, but it's something to look into and to aspire to for every startup, and to start to mold your charter.
Yeah, thank you all for that input, and want to be wary of the time because I do know we have a mini keynote coming from Vicki to close us out. But I do want to quickly maybe do a lightning round of some of these questions in the chat so that our audience members can get a few of these answered. So if we can maybe have one person hop in and answer these if they're relevant. The first one here is, do we need to be accredited to invest in these early stage angel investment impact funds? Anyone want to take that?
For my fund, as an angel fund, you do have to be accredited. This is all regulatory. And I touched on what that means. Now, if you know somebody who asks you to invest in their company and you're not part of a fund, the police aren't going to show up and say you can't put $10,000 into your friend's company. So there is a lot of informal private company investing going on. But I would say that, if you do that, be sure that it's not going to jeopardize your financial situation. The reason why they have these requirements is these investments may not come back to you. They're typically a long tie-up. There's sometimes transparency. So you need the sophistication financially to absorb any potential losses. But the nice thing is, I think the world is shifting in a way where we want these early stage investments can be so lucrative. The returns can be so fantastic that it is important to ask, is there a sound way for, like in a crowdsourcing environment, people can put smaller dollars to play in what might become the next Amazon? It's sort of like, why should we leave the most lucrative investment opportunities for the most sophisticated and well-heeled investors? Can we do it? Can we make it available to everybody in a way that's not going to damage them if it doesn't work out? Does that make sense? Was that a convoluted answer?
No, that was great. We'll take another from the chat here. What do you guys see as being the biggest challenge for VC and angel investors once we emerge from the pandemic?
Oof.
A softball, right?
I'll take a quick view on that. I'll talk from a standpoint of impact investing. I don't think the fundamentals of any business changes in this environment. If anything, it magnifies our weaknesses. Whether it's a capital stack issue, whether it's a recruitment issue, whether it's a minimum viable product issue, right? You have to have those filters ongoing on a daily basis. I think if anything, a pandemic like this magnifies those issues and makes you stick to your core upfront, know what you're delivering, both to your customers and your shareholders, whoever they are, and you have to drive that in a very, very narrowly focused issue. I think the area that every investor or entrepreneur looks at and has suffered through this process is cash, right? If your cash burn is greater than your capital stack or your revenue stack coming in, that's something you need to decide is what is your length? What is your length of your runway? Those are all basic fundamental blocking and tackling. I think we get carried away by investors asking for something, customers asking for something else, and then you have this creep of mission, and then you can't deliver on your core mission. So stick to the MVP, stick to getting things done, your basic, blocking and tackling. Can't get away from that. So that's my first take on that.
Thanks, Zain. And, we have some other great questions in the chat, but given that we are out of time, I would encourage the three of you to maybe look at those questions and answer them in the chat for our audience members. And just want to thank you all, Stephanie, Zain, and Vicki, for being a part of this panel, and Michael for popping in as a surprise panelist. So grateful for your input and insight and your flexibility this morning. So we'll now pass the stage over to Vicki, who's going to give us a wonderful keynote to close us out. So thanks, everyone.
Thank you, Sydney. Bye, everyone. So I've already introduced myself, and I thought I'd spend a couple of moments talking about the role of corporations in society. Climate change, biodiversity loss, social inequality, income inequality, social injustice, all are issues that are threatening us today. They have long lurked for decades in the shadows, and now we're emerging. Time is of the essence, and action is now required, immediately and decisively. All stakeholders must act in a coordinated and collaborative manner to reverse and mitigate and change the trajectory we are on. But how? As voters, we can encourage legislators to pass meaningful regulation. However, governmental directives often only address issues on a regional level, require a long runway for constituent education and eventual implementation. Multinational incentives are much more effective. How opportunities like the United Nations Paris Climate Accord require long periods of time to develop consensus due to the disparate situations of individual nations. And as is true, unfortunately, with the Accord, these opportunities are limited in effectiveness without the participation of the largest influencers, such as China, India, and the United States. As consumers, we can influence the goods that are produced by our purchasing decisions, boycotting brands that don't align with our values, and promoting those that do. With the infiltration and importance and use of social media, brand reputations are easily made and broken by a few tweets, posts, or likes. As employees, we can influence the operating policies and procedures of our employers surrounding employment, recruitment, workplace conditions, compensation, and grievances. Recently, for example, Amazon employees posed demonstrations and protests related to environmental issues from Amazon, as well as health and welfare concerns in their warehouses. It is our role as investors, however, that is perhaps our most influential and powerful. As shareholders of public companies, we have the power and the ability to influence companies' actions and their impacts. Through advocacy, engagement, and eventually or ultimately shareholder resolutions, we can change the behaviors of public companies and move forward as a global community a more inclusive and sustainable agenda. Why are public companies so important? In 2019, the Fortune Global 500 companies employed almost 70 million people, almost 8 times the amount that reside in Manhattan, and contributed 94 trillion in global GDP, representing 2/3 of global GDP. Additionally, as most recently reported in the Richmond Times in October, the top 90 companies produce 2/3 of the greenhouse gas emissions in the world. Corporations, with their vast wealth of cross-global resources, employees, financial capital, and technology, are the only stakeholders capable of solving wide-scale social and environmental injustices and environmental crises. For example, as we have witnessed most recently, most governments did not rely on their own agencies for the development and production of a vaccine against coronavirus, and instead delegated its resolution to those international pharmaceutical companies best qualified and most prepared to deliver an effective and efficient cure. Corporations provide a benefit to society by creating employment and by producing goods and services that the populace demands. Companies, however, often adopt policies and procedures that, while maximize shareholder wealth, are accompanied by unintended social and environmental consequences, the costs for which remain indeterminate, unassessed, and ultimately absorbed by society at large. Pollution, greenhouse gases, and land use change, along with social inequities and compensation inequities, are a few of the externalities of corporate operations. Investors have long been aware of the significance of the role of corporations in society, and to that end, for hundreds of years, have tried to influence the behavior of these entities. This mode of investing, socially responsible investing, impact investing, is founded on the principle that investors can achieve market outperformance through investing or allocating capital to good companies while avoiding investment in companies whose products, operating methods, and impacts have perceived harms to society. This capital allocation methodology of divestment or avoidance is designed to encourage changes in the behavior of those companies whose policies lag behind on corporate responsibility. Beginning in the 1700s, under the leadership of John Wellesley, the head of the Methodist Church, avoided investing parishioners' donations in any businesses that might, quote, harm thy neighbor, unquote. They screened out investments in sinful companies, such as those involved in the distribution and manufacture of firearms, tobacco, and alcohol. This method of restrictive screening or avoidance is practiced today by many religious, educational, and philanthropic institutions. It was not until 1970, however, when corporate advocacy was introduced as an instrument of change. Ralph Nader, a consumer advocate, green candidate, and environmentalist, succeeded in having 3 social resolutions on the General Motors proxy ballot, including one that would have the company undertake no business activity that was detrimental to the health, safety, or welfare of the citizens of the United States. Anecdotally, at that time, General Motors was the largest private sector employer in the U.S. Fast forwarding to the 1980s, the Calvert Social Index Fund was the first mutual fund to formally integrate environmental, social, and governance criteria into its financial analysis of stock price valuations. When ESG was first conceptualized, the data was manually retrieved and collated, often through dialogue with company management. As one might imagine, this process was extremely subjective, biased, and time-intensive. However, as the ESG usage gained popularity and grew, automated data vendors and data miners entered the space in the 1990s, facilitating more inclusive ESG integration. ESG integration, designed to benchmark companies against their peers using key material, social, and governance and environmental indicators, resulted in capital allocations into those companies that performed above their peers on these metrics. However, while ESG data provides snapshots of company performance, much like a balance sheet, at certain points of time, different points of time for most of the data, it is not granular enough to evaluate the true costs of a company's operations. And although it has resulted in some capital reallocations, it has not manifested, unfortunately, in material changes in corporate behavior. That kind of fundamental change, however, could be achieved through integration by investors of the triple bottom line and stock price valuations. This concept, introduced in the 1970s by John Elkington, one of the fathers of sustainability, recommends that businesses analyze the full costs of their operations, including those borne by society and not compensated for. Through implementation of this triple bottom line accounting analysis, investors could calculate revised earnings, data that would incorporate social costs and revise traditional stock price valuations, thereby holding companies accountable and by investing in only those companies who have positive triple bottom lines. Examples of innovative companies that with absolute net positive value include Beyond Meat and Tesla. Although livestock consumes nearly 80% of the agricultural land, it produces less than 20% of total calories and contributes approximately 15% of greenhouse gas emissions. An investment in Beyond Meat and consumption of its alternative meat products is a net positive for the planet for greenhouse gas emissions, forest deforestation, and of course, animal suffering. Since its initial public offering in just May of 2019, Beyond Meat has returned 95.1% to its investors. Innovation is at the core of Tesla's culture and is enabling the company to disrupt the automotive industry as one of the only long-distance cars. Whom can disagree with Tesla's CEO, Elon Musk, that the fundamental purpose, the fundamental good that Tesla provides is accelerating the advent of sustainable transport and energy production. It's very important for the future of the world. It's very important for all life on Earth. Investment in Tesla and use of its electric vehicles reduces greenhouse gas emissions through the elimination of the use of fossil fuels. Since its initial public offering in 2010, Tesla has returned to its investors a mind-boggling 8,630%. Certified B Corps and Benefit Corps recognize and ensure the sustainability of their operations formally through their corporate structure and organization. Certified B Corps meet the highest standards for social and environmental performance, public transparency, and legal accountability. The 3,500 certified B Corps around the world strive for reduced inequalities, lower poverty levels, and a healthier environment. To achieve B Corp status, as you all must know, you must receive a minimum score on social and environmental performance, integrate B Corp commitments to stakeholders into governing documents, and pay an annual fee based on revenues. Every 3 years, companies must recertify to ensure they are maintaining social and governmental and environmental commitments. My firm, Karner Blue Capital, is a certified B Corp, one of approximately 100 certified investment managers. Karner Blue Capital is an SEC registered investment advisor committed to moving forward the capital markets for the protection of biodiversity, environmental stewardship, and animal welfare, while providing competitive market returns to our investors. Similar to B Corps, benefit corporations require companies to consider the impact of their operations on stakeholders outside of their shareholder base. Benefit corporations like Patagonia codify and cement their mission in their corporate documents. Patagonia's corporate mission is quite simply to save our home planet. But leaders in triple bottom line progress are not just those young companies in transformative industries with unique products like Beyond Meat or Tesla, or those that are organizationally different like Karner Blue Capital or Patagonia. There are also companies in more mature stages of their life cycle and existence. Companies like Microsoft, that while providing solid returns to its shareholders and delivering superior software products to their clients, has recently launched a biodiversity measurement tool, Transformative, that allows ecologists and conservation technologists to monitor biodiversity loss on the planet. Microsoft most recently has also just recently pledged to become carbon negative by 2030. Whether private or public, corporations are the only stakeholders with the depth and breadth of resources to manifest material, social, and environmental change. Investors have the ability to influence the behavior of corporations by incorporating full cost accounting methodologies into their stock price valuations. Through allocated capital to those innovative, transformative, committed companies with net positive bottom line impacts, capital will be reallocated to those that boost the good of society while encouraging those that lag behind to move forward in their actions. Most of you in this room are investors. whether through your brokerage account, 401k contributions, or Robinhood dabbling investments. You are investors. No matter the size of your portfolios, you all have a role and a responsibility to further the evolution of investing and influence the role of corporations in society. I hope you will join me in this endeavor and move forward the capital markets towards a more inclusive and sustainable future. Thank you.